Thank you all again for joining us for our very first Lawyer's Choice webinar. These webinars will be hosted by your trusted advisor, Renee Krause, the president of Lawyer's Choice. Renee's background is in law. She graduated from the University of Denver School of Law in 1994 with a JD and a concentration in corporate and international law. After working for several local law firms, she moved into the insurance industry. In 2005, Renee founded Lawyer's Choice, formerly known as Insurance Consulting Services, and over the past 16 years, she has successfully grown from a local brokerage to a national presence, serving clients in 48 states. As a former practicing attorney, Renee understands the full spectrum of how to protect a law firm, and she works relentlessly to determine the needs of each client and ensures they receive the most comprehensive coverage at the very lowest premium possible. So without further ado, I would like to introduce Renee Krause.
Hi, everyone. Thank you, Heather, for that nice introduction, and thank you to everyone for joining us today. We're so glad you could be with us. This is our LPL Insurance Basics webinar series, and today is an introduction to policy terms. I've been doing this for about 20 years now, and I find that I get the same questions over and over. And it's such an important purchase for a law firm, not only in the premium dollars spent, and these policies are quite frankly pretty expensive, but also in the ability for the policy to protect the firm from financial devastation in the event of a claim. So it's so important, yet many of the terms are very confusing because these policies really aren't like anything else that you might be familiar with. So I'm hoping in this series to kind of disseminate it, break it down, make it real easy in small bites, and then we'll proceed through more content. Today is kind of superficial and just limits, deductible, real basics. Also, I want to let you know that everyone's anonymous, so if you want to ask questions at the end and they're specific to your firm, we won't know that. And also, we are recording this and we'll send it to you at the end along with the outline that we use and a little cheat sheet that we've prepared that will have all the terms and definitions that we talk about for you to pull out and use every time you deal with these policies. So with that, we will go ahead and get started. As Heather mentioned, we are a national broker and we specialize in insurance products for law firms. And today we're focusing on malpractice insurance, but we have three products we really are specific in, and that is, of course, the LPL, cyber data breach, and employment practices liability. These three policies are very similar in that they're specialty lines and they're all claims-made policies. So in addition to the LPL, in future webinars, we'll dig into those, but it's just LPL today. Okay, definition. What is a professional liability insurance policy? It's a claims-made policy that protects law firms and individuals that work for the law firm against claims made for inadequate work or negligent actions. So it's pretty basic, but it basically, it is what it is. It just basically covers any mistakes that you make. The important thing to know is that it covers unintentional negligence, ineffective assistance of counsel claims. These do not cover intentional acts, fraudulent, or theft. So in the event someone in the law firm is embezzling from a client, that would not be covered under these policies. But basically everything the firm does in the practice of law is covered under the policy. Okay, this is important because most of the policies that as consumers we're familiar with are occurrence-made policies. And these are claims-made policies. So you can compare and contrast. An occurrence-made policy is what you have as a homeowner or an auto policy, right? So homeowner, auto policies, health insurance, those are all occurrence-made policy, meaning that when the claim happens, the carrier insuring you at the time of the occurrence is who pays the claim. So that's occurrence-made. Claims-made policies, which is what LPL policies are not occurrence-made. And the biggest difference, well, the difference is that the event which triggers the claim can happen many years before the claim is actually made. and years before the carrier that is insuring you at the time the claim was made will pay on that. So that's the biggest conceptual difference. We get a lot of, some people will call us and they'll say, you know, oh, this happened 3 years ago, I need to get in touch with that carrier, but that wouldn't be true. So with these policies, whomever is insuring you at the time the claim is made is the carrier that would respond to and pay out on the claim for the firm. Okay, who is covered? Well, LPL policies cover everyone who works for the firm, attorneys, paralegals, receptionists, law clerks, etc., from the date they are hired moving forward. I mention this because the applications, I'm sure many of you are familiar with them. There's a section that will have a roster and it will ask you to enumerate all of the attorneys that work for the firm, their dates of hire, their bar admit dates, and that can lead some to believe that those are the only people covered, but that's not true. Everybody in the firm is covered for what they do on behalf of the firm. And the reason it's just the attorneys on the application is that's used to actually rate and prepare a premium for the law firm. So it's not a definition of who's covered under the policy. So important to know that anyone who works for your firm is covered under these policies. Okay, what is covered? Professional liability, LPL policies cover, of course, professional services that a law firm typically engages in. So contract review, contract creation, opinion letters, appearance in court, depositions, motions, all of that, of course, is covered. A few things that are covered under the policies that many people aren't aware of are other things that law firms are engaged in. So one example would be arbitration and mediation services. And that's fairly new. 10 years ago, LPL policies did not cover those. However, many law firms are now moving into that, and it's becoming a big segment of their revenue. And so now policies have responded by including arbitration and mediation services under the professional liability policies, which is great. Another area that is covered and considered part of the professional services is notary services. So many firms have, in-house notaries, and important to know that those services are covered under these policies. And then finally, fiduciary and trustee services are also covered. That's a question I get a lot. It's an estate planning firm who has a client that wants them to be a co-trustee, maybe along with their bank and a family member in a trust, and the firm is concerned they wouldn't have coverage, but you would have coverage in that capacity as a trustee and a fiduciary. And so that's pretty much it. But I would say that, each policy, these are generalities. Each policy is a little bit different. If you're ever concerned about what is or isn't covered, you can go into the definition section of your policy, which is usually the first couple pages, and you can look at professional services, and you would get a really nice description of what's covered. And then, of course, if you're still not sure, you can call your agent, you can call me. It's easy to figure that out for us. Limits of liability. Okay, seems easy, but it can be a little bit confusing. So we'll dig in first to limits of liability. How many limits, or how high of a limit does your law firm need? Two things that you should think about are number of attorneys in the firm and areas of practice. Both of those will drive the decision as to how much of a limit your firm needs. So if you're a smaller firm of maybe 3 attorneys and you're engaged in a fairly low risk area of practice, for example, criminal defense work is pretty innocuous in claims world, you would probably be fine with a 1 million limit. There's only 3 attorneys, so there's not a ton of activity that will produce more than 1 claim within 1 policy period, and $1 million would probably be okay. Conversely, if you're working with a firm of 10 to 20 attorneys, you would definitely want higher limits. More activity produces more exposure to a claim, and you could have several claims within 1 year. So you would definitely want to consider higher limits with more attorneys. Something to think about, though, when we talk about claims and limits, if you have multiple claims springing from the same event, it's considered 1 claim by the carrier. So just be clear on that when we talk about claims. And then also if you're engaged in a high risk area of practice, for example, a personal injury plaintiff firm that handles class action matters, well, when those are, when those go south, they're very, very expensive. So even if you were smaller, but you were engaged in a risky area of practice, you would certainly want to have higher limits. So that's really the two, basic criteria in thinking about how much insurance should we buy. And the other thing to think about when you are looking at limits of liability are the two ways that they're treated. So you can either have a limit with claims expense inside the limits, or you can have it with claims expense outside the limits. So CEIL or CEOL. And the difference is when you have claims expense inside the limits, that means that any money spent by the carrier defending your claim will reduce the amount available to pay the claim. And with claims expense outside the limits, it's the opposite. So any amount spent to defend the claim would not impact what's remaining to pay the loss or indemnity. So here's a simple example. If you have a 1 million limit policy and you have a claim and 100,000 is spent on defense costs and you had a CEIL limit, claims expense in, you would have 900,000 available to pay the loss or indemnity to the claimant. Conversely, with CEOL, same thing, 1 million limit, $100,000 spent on behalf of your firm, you would have the full 1 million available to pay the loss or indemnity. And why that's important is as you get higher limits, if you have 5 or 10 million limits, that becomes less important. But when you have lower limits of 500 or a million, the cost of defense eating away at what's left to pay the claimant could be significant. So you want to think about that. And maybe sometimes if you think you want to increase your limits, what you do is you keep your limits, but you just move to a CEOL policy, which would accomplish basically 1 million left to defend and 1 million to pay. So just those are two ways that the limits are treated. And it's really important to know which one you have and make sure that you're comfortable with that. Okay, deductible, another basic in our policies. So deductibles are treated two ways, and then there's an additional component, which is the third I'll talk about. But per claim and aggregate are ways that a deductible is treated. So per claim means there is no limitation to the number of times you would have to pay a deductible in the event of multiple claims. So if you had a $5,000 deductible per claim and you had 2 claims within the policy period, you would pay $10,000. An aggregate deductible caps it. So that means if you have a $5,000 aggregate deductible, no matter how many claims you had within the policy period, you would only pay that deductible one time. So again, very significant when you take a look at the amount of the deductible your firm currently has. If you have a very low deductible, maybe 1,000 or 2,500, you might be okay with the per claim. If you have a higher deductible, you might want to go with an aggregate. A $10,000 deductible paid a couple times, that would be significant. And then the third way a deductible is treated is first dollar defense or loss only defense deductible. And this is an extraordinary provision. I recommend it to all of my clients. Not all carriers offer it. It's kind of it's hard to find. Only a few offer it anymore. But first dollar defense is what dictates when and if your deductible is paid. So if you have a first dollar defense deductible, out of the gate when that claim is made, you do not pay your deductible. You wait until the matter is resolved, concluded, and then you would pay at the end. However, if the matter was limited to defense cost payout by the carrier and no actual loss or indemnity was paid to the claimant, you would never pay the deductible. And that's great. So that shields a firm from frivolous or meritless lawsuits where, after a little discovery, there's some defense cost, but it never moves on to a claim that actually pays out. That means you never pay your deductible. Another great value in a first dollar defense deductible is the timing. So with that component, with that coverage, you don't pay at the beginning. Even if the claim does have merit, you have until the conclusion of the matter to owe or pay that deductible. And that's just very nice for timing. You have some time to prepare for it. If you have a big deductible, it gives you time to manage that cash flow, so you don't have to pay it right out of the gate. So those are the ways that deductibles are treated on the LPL policies. Okay, retroactive date and prior acts. Okay, a retroactive date defines how far back in time a loss can occur for the policy to cover a claim. If a claim happens prior to your retroactive date, it is not covered under your policy. So earlier, I talked a little bit about claims made versus occurrence made. And in that discussion, I said that the policy will respond to a claim that could have happened years before that carrier was insuring the firm. This is a limitation to that look-back period. So a retroactive date, also known as a prior acts date, is a limit on how far back an event could have occurred that would be covered under today's policy. Typically, the retroactive date or the prior acts date is consistent with the formation date of the firm. So if a firm was formed in, say, January 1st, 2000, that would be their retroactive date. And that's the limitation to the look-back period. Now, full prior acts functions the same way as the retroactive date. It actually replaces it, and it expands it even further. It says there is no limitation to the look-back. This claim could have happened anytime during the existence of the firm, or maybe a predecessor to the firm, without limitation. And it's called, so that's full prior acts. Typically what happens after an amount of time where retroactive date, a specific date, is no longer relevant. For example, if you have a firm that began in January 1st, 1945, there's no need to designate 1945. It's so far back, it would be replaced with full prior acts. So those are the two ways you'll see that look back period designated on a declarations page. Also, it's important to recognize with retroactive dates, that time is accumulated as long as the firm continues uninterrupted with no lapse in coverage. So it's real important to keep your policy in place and never let that lapse, because if you do, you will lose all that prior acts coverage you accumulated. So here's an example. If you have a policy for 10 years and you decide you're going to let it lapse for whatever reason, and then you decide a year later to buy a policy, it will not pick up that original retroactive date. It will start from the date you buy that new policy. That's why it's very important to pay attention to that. And also, if you move between carriers, you want to make sure that that retro date is the same, that the new carrier is going to match that look back period for your firm. So, okay, so that is our basics today. Pretty short and sweet. It's only about 15 minutes. And now what we'll do is I'll turn it over to Heather, and if you have questions, please ask them. And you don't have to limit it to what we talked about. This is a basics, but I'm happy to answer any questions that are on your mind.
All right, we have a bunch of questions coming in here. Let's start with our first one. Why do LPL premiums vary so drastically between carriers?
Great question to whomever asked that. So that's a real mystery. And, you know, if you occasionally look to different brokers to provide you with quotes, you'll see that there's a big variance and it's confusing. And the simple answer is carriers have very specific underwriting appetites. And when you fit into their program, you are going to get the best rate from that carrier. It doesn't mean they won't write other firms, they will, but those firms won't get as good a rate as the firms they're looking for. So that means that if you, so for example, you don't necessarily have to be a low risk firm. It's more of where a carrier has decided from a business perspective, they want to go after a certain market segment. It could be personal injury firms, or it could be intellectual property firms, or it could be firms between 1 and 5. So once they decide that's their target, firms that meet those guidelines will get a better rate than firms that don't. So what you can see is when you have lots of variance in premiums, the lower premiums are because you're fitting into that carrier's desired client base.
Our next question is, what is the significance of the AM Best carrier rating?
Okay, AM Best company is an independent entity that evaluates the financial size and stability of insurance carriers. So, and they have different ratings. We only work with A or higher rated carriers. So in our tier, it goes from A- to A to A+ to A++. And what's important to know about those tiers is that A is very good. A+ superior, those are the best, but A- isn't bad either. Something to note about an A- carrier is, it may mean the carrier is heading in a bad direction financially. It could be a warning, but not always. Because whenever a carrier grows in financial size or adds a new product, AM Best will automatically assign them an A- rating because the future viability of that new condition is unknown. So they're conservative and they will give them A-, and maybe next year they'll be back to A+. So if you see something that you like, but the carrier is A-, just dig into it with your agent. You can go on to AM Best yourself. It's ambest.com, and you can sign in. You don't have to be an insurance agent to access all that information. So the A rating determines the financial forecast for the firm. And then the class size, it goes anywhere from a class 7 carrier up to a class 15 is the highest. And that is the financial size, or the amount of assets under management that that carrier has to provide coverage. So basically, the larger the financial category of the carrier, the more money they have to pay claims. So really, the more financially stable they are.
All right, our next question, is there any harm in moving carriers every year for a better premium?
Yes, there is harm in that, except in an extraordinary situation. So when you are with a carrier, it's a great idea to plan to stay with them for 3 years. The reason for that is, well, initially, when carriers see that you move around a lot, they'll see that in the insurance history on the application, they are uncomfortable offering you their best quote. They're uncomfortable with taking you on as a risk because they want to get what's called a premium to loss ratio, a favorable premium to loss ratio. So they wouldn't want you to come on and stay with them for a few years. And then if a claim pays out, it's favorable because they've taken on premium, and now paying out the claim is okay for them. And also it will allow them to not increase your rate necessarily high in response to the claim, nor non-renew you. So if you constantly jump around and then you're with the carrier for 1 year, and in that year you have a claim that they pay out on, that can harm you because they don't have a favorable premium to loss ratio for your firm, which means they will then need to increase your rate substantially, or worst case, non-renew you, which is bad because then other carriers take that to mean you're a more risky firm and they won't want to, offer you their better pricing. So that's the harm. Also, the other harm is there often are provisions within a policy that you earn once you have time with a firm, with a carrier. So a couple of them are, when you've been with a carrier for, say, 3 years, you may have earned a loyalty discount. You may have earned a free retirement tail policy, an ERP. You may have earned a 50% deductible reduction. There's things you earn after time with the carrier because obviously they want you to stay with them. But be careful moving because you might be giving up a lot more than just what's on your deck page in limits and deductible. You may be giving up a lot of coverage that can down the road end up costing the firm a lot more.
Okay, so our firm has reported several potential claims in the past 5 years out of an abundance of caution. All of them are closed out and no money was spent by the carrier, yet our premium has gone up. Can you explain why?
Yeah, that's a great question. We get that a lot. And the reason for that is there are 2 ways that carriers view claims. One is severity and one is frequency. So severity obviously is you have one claim after 10 years, 15 years, and it's $350,000 or more. That's a severe claim. But another scenario they like to avoid is frequency. So when you over-report to your carrier, even though it's $0 spent and every claim is closed, the carrier reads it as, obviously this firm is uncomfortable with the way they're doing things. They're worried everyone's going to make claims against them. They're not managing their clients well. They're not managing their cases well. And so we're nervous to offer them coverage because we think that eventually one of these claims will, become more than just a zero balance. So the answer to that is you don't want to report everything, but you need to report what you need to report to get coverage. The best way to answer that to whomever asked is to read your policy and determine what your policy says you need to report and when you need to report. And that's when you report. So I know that the intention is great. You want to make sure the carrier's on notice. They're going to appreciate it, but it can actually work against you sometimes.
Why doesn't my rate decrease when I fire a problem attorney?
Okay, good question. That would make sense that if you let someone go, your rate should automatically go down, right? Okay, so as we've discussed, because these are claims-made policy and a carrier is taking on risk of claim from activity that's happened many years in the past, when an attorney leaves your firm, even though they leave, all the work they performed on behalf of the firm, that it results in a claim remains covered under the policy. So even though that attorney is no longer with the firm, their activities are still with the firm. So that's a risk that the carrier needs to collect a premium to cover, basically.
And why do I want an admitted carrier?
You may not want an admitted carrier, it depends. So what that question is referring to are the two ways that carriers are deciding can do business in a state. One is on an admitted basis and one is a non-admitted basis. A non-admitted basis means the carrier is looking to insure riskier firms and can be more flexible in the way they underwrite. And they can do that because an admitted carrier, when you're admitted, you have to file your underwriting guidelines with the state, and you also have to participate in the state guarantee fund. So you really are limiting what you can insure. You've defined it and it's with the state, you can't vary. And you participate in the state guarantee fund, which every state has, and that protects insureds from a carrier becoming insolvent and unable to pay a claim. So that fund goes to replace monies that the insolvent carrier would have paid. But it is a restricted program, so those products or insurance policies admitted basis is for firms that are very easy to insure, right? Low risk firms, no claims, no difficult areas of practice, not 100 or 200 attorneys. So that's an admitted product. And then there's non-admitted, and non-admitted, of course, can be more flexible, and their desire is to underwrite riskier firms where they can make that decision as they underwrite. So they don't have to file their underwriting guidelines and they don't participate in the state guarantee fund, but they do have to purchase reinsurance to replace the money that the state guarantee fund would have paid an insured should that carrier become insolvent. So that's the difference. One really isn't better than the other. They're just built for different risks, different types of law firms. So typically though, I mean, the quality of the carrier is not different, but the policy will be different. So for sure, an admitted product, an admitted carrier, admitted policy would have more coverage, more bells and whistles for a firm. It would be less expensive. A non-admitted product would be more expensive, typically, and it might have a little less of the bells and whistles, but it might be able to do more that a firm wants that an admitted product can't do. So it could offer you much higher limits than an admitted product could. So there's different variables, but they're both very good.
Okay, I think we have time for one quick last question. Let's do, what can I do to get a better rate?
Okay. That's a good question. That's a big question. That's actually another webinar, but I'm going to answer it quickly if people can stay on a moment longer. What you can do to get a better rate is great risk management systems in place. And that means, you know, multiple docket systems, conflict of interest systems, engagement letters, non-engagement letters, termination letters. When a matter is resolved, you send a letter out to the client that says, we're done with representation. The matter you hired us for is closed, and please come see us again. But a nice bright line of where it stops. You know, a good risk management program, which now almost every carrier has a built-in risk management program that you can take advantage of as an insured by contacting your carrier. They have free risk management hotlines. They have pre-claim assistance. If you're concerned, you can often call anonymously and get a little feedback on whether you should report something or not. You can talk to your agent about that. There's a lot of stuff that the carriers provide for free, and a lot of people don't realize that. But if you look at your policy, you've got those programs. You can also be very cautious in vetting clients. That's a big source of claims, is just being very careful in how you decide to represent a client. And then also, you know, good retainers up front, so there's no issue with collecting later. Good communication with the client, constant communication. The ABA did a study a few years ago, and it determined that the biggest source of claims was just not returning a client's phone call. Believe it or not, that was the nexus when you drill down, was not being responsive to the client. So as much as you can keep that communication open with email and invoicing and billing regularly and calling them and returning their calls, that really does eliminate a lot of claims. So, okay, I think we are over our time. Thank you for staying on a little bit. Again, the intent was to keep this very short and sweet and real small bites. Our next seminar is next month. Heather will talk to you about that. But thank you so much for joining us, and looking forward to seeing you next time.
Thank you all again so much for joining and participating in our very first Malpractice Insurance Basics webinar. We hope you found this information valuable, and we would love to see you all again here next month for episode 2, How the Answers on Your Application Impacts Your Insurance Rate. Please reach out to us with any other questions or webinar topics you would be interested in. Thanks again, and have a great day.